According to recent data, foreclosure starts jumped 30% and foreclosure sales increased 25% nationwide. With housing crash predictions circulating on YouTube since before 2020, many wonder if the doomsayers were right all along. I've analyzed the ICE Mortgage Monitor report, the most authoritative data source in the mortgage industry, to understand what's really happening. Today, we'll break down the numbers to reveal what this surge actually signifies. The VA foreclosure increase is real, but the complete data tells a story that differs significantly from what many alarming headlines suggest. Could those alarming foreclosure numbers we're hearing about lately be the beginning of a housing market crash that so many have been predicting since before 2020? Looking at the March 2025 ICE Mortgage Monitor, we see foreclosure starts jumped by a whopping 30% and sales rose 25%, hitting their highest levels in 5 years, with over 40,000 loans referred to foreclosure. These statistics appear frightening. Exactly the type of numbers housing crash predictors point to as evidence the market is beginning to crumble. But examining the report more carefully reveals something crucial that completely changes the narrative. This surge isn't driven by widespread market distress. It's primarily the result of the VA foreclosure moratorium expiration in January 2025. This policy had temporarily halted foreclosures on VA loans during the pandemic to protect veteran homeowners, and its end created a predictable processing backlog. When we examine the broader context, we see this as a policy-driven event affecting just one segment of the market. Breaking down foreclosure starts by loan type reveals a telling pattern. While VA foreclosure spiked dramatically, FHA loans actually saw foreclosure starts decrease by 2% year over year. Even more significantly, conventional loans experienced a 4% drop in foreclosure starts. This stark contrast between loan types raises an important question. Why would only veteran homeowners suddenly struggle with payments? The concentrated nature of this foreclosure surge signals we aren't witnessing a broad market collapse. The March 2025 Mortgage Monitor confirms this point. The overall increase in foreclosure starts stems almost entirely from the spike in VA referrals. January's increase in foreclosure sales primarily reflects the resumption of normal VA foreclosure processing following both the holiday moratoriums and the longer-term VA-specific moratorium. The system is now working through a backlog of already distressed loans that had been artificially held back. So yes, the VA foreclosure surge is real, but it represents a return to normal processing after artificial suppression. This isn't the beginning of a housing crash. It's the foreclosure system catching up with previously delayed cases. If you've been following me for a while, you know my experience has taught me that informed consumers save money and are happier during their move. That's why I deliver market reports from numerous sources, analyzing the U.S. housing market from all angles. Today's report from ICE was derived from its recent Mortgage Monitor report. If you're not a subscriber, please click the thumbs up like button and subscribe now to get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. Here's a fascinating paradox that challenges the basic narrative about foreclosures. While we're seeing those rising numbers, fewer homeowners are actually falling behind on their mortgage payments. The national mortgage delinquency rate dropped by 24 basis points to just 3.47% in January, according to the March 2025 Mortgage Monitor. That's a 6.6% improvement, more than double what we typically see month to month. This contradiction represents an important insight into what's actually happening in today's housing market. Looking deeper into the recovery patterns reveals a compelling picture. Nearly 500,000 previously delinquent borrowers, 490,000 to be exact, returned to current status in January alone, representing the highest volume of recovery in a full year. This is like seeing the housing market's immune system kick in while minor symptoms appear elsewhere. The improvement extends across all delinquency categories, including the crucial 90-plus day serious delinquencies that typically feed into foreclosure. If broad market deterioration were occurring, these serious delinquencies would be rising, not falling. The recovery is even visible in areas affected by natural disasters. Hurricane-related delinquencies have dropped significantly, falling from 58,000 in November to 48,000 through January. This indicates that homeowners who faced catastrophic events are finding ways to recover and maintain their mortgage obligations. However, challenges remain in specific regions. The Mortgage Monitor highlights the emerging impacts of California wildfires. Approximately 680 borrowers in affected areas missed their January payments, with 3.5% of borrowers within the Eaton wildfire perimeter and 3.2% within the Palisades perimeter falling behind. Early February data suggests significant impacts ahead, with roughly 1 in 6 borrowers in Eaton and nearly 1 in 4 from Palisades paying more slowly than they did in December. While these localized events create pockets of concern, the national recovery numbers paint a more balanced picture. What's particularly striking about these figures is how localized and event-specific they are. We're observing very specific impacts tied to particular events or policy changes rather than broad-based deterioration across markets or loan types. Those localized disaster impacts pale compared to the financial burden hitting virtually every American homeowner. Most analysts overlook the fastest growing expense in your monthly housing payment isn't your mortgage interest or even your property taxes. It's your homeowner's insurance, and the numbers are staggering. When we break down the components of PITI, principal, interest, taxes, and insurance, the average total mortgage payment increased by 6% last year. Property insurance premiums jumped by a record $276 in 2024 alone, representing a 14% annual increase and bringing the average annual premium for mortgaged single-family homes to $2,290. This represents a concerning multi-year pattern. Since 2020, property insurance premiums have skyrocketed by $872, a 61% increase in just half a decade, while all other housing payment components increased by only 21 to 22%. This additional expense is an unexpected weight on homeowners struggling with high housing costs. These trends are particularly pronounced in western states, where increases have outpaced national averages. Seattle and Salt Lake City both experienced 22% increases in 2024, with Los Angeles following at 20%. In the South, the burden is equally heavy in dollar terms, with Dallas homeowners facing a $606 annual increase and Houston close behind at $515. Several factors drive these dramatic increases. The average annual insurance premium per $1,000 of coverage has jumped to approximately $5.40 in 2024 compared to $4.66 between 2014 and 2022. Homeowners are attempting to manage these costs by accepting higher deductibles, with new borrowers in 2024 taking deductibles averaging $390 or 19% higher than typical mortgage holders. In contrast to these increasing costs, the overall market shows signs of cooling. The ICE Home Price Index indicates annual home price growth has slowed to 3.0% in January, down from 3.4% in December, a moderation rather than a collapse. For potential home buyers, there's at least one positive development. Inventory levels have improved substantially. The national deficit has shrunk from minus 40% a year ago to minus 25% today, indicating better supply conditions across nearly every major market. The substantial equity position of homeowners is the key stabilizing force in today's housing market. When we talk about why we're not seeing widespread foreclosures despite rising costs, the answer is written in the balance sheets of American homeowners. They're sitting on a mountain of equity that creates an entirely different market dynamic than what we saw in 2008. U.S. mortgage holders now possess an astonishing $17 trillion in total home equity entering 2025, up 6% from just a year ago. $11 trillion of that amount is considered tappable, meaning homeowners could borrow against it while still maintaining a healthy 20% equity position in their property. At the individual level, the average homeowner today has $313,000 of equity, with $203,000 of that available to tap if necessary. This creates a powerful financial buffer that was absent during previous housing downturns. Unlike in 2008, when negative equity snowballed into crisis, today's substantial positive equity offers homeowners a robust financial cushion. The combined loan-to-value ratio across all mortgaged properties now sits at just 45.5%, down from 45.9% last year. This means the average mortgaged home carries less debt relative to its value than before. This equity position fundamentally changes how homeowners respond to financial stress. When facing higher insurance premiums or other cost increases, today's homeowners have options their 2008 counterparts simply didn't have. Instead of being forced into foreclosure or distressed sales, they can tap their substantial equity if needed. We're seeing strategic equity used in action. The improved rate environment in late 2024 led to the strongest fourth quarter equity withdrawal in 3 years, with homeowners accessing $46 billion, a 26% jump from the same period in 2023. This came through both second lien home equity products and cash-out refinances. Yet homeowners remain historically cautious. The fourth quarter withdrawal rate represented just 0.41% of available tappable equity, well below the 0.91% average extraction rate we saw in the decade before recent Fed rate hikes. This translates to over $500 billion in untapped home equity that hasn't flowed back into the broader economy. Looking ahead to 2025, the narrative is not one of widespread collapse, but rather of a market processing past policy-induced delays. The projected 15% increase in foreclosure referral activity stems primarily from the processing the VA backlog, not signaling a housing market crash. The fundamental stability of today's market comes from homeowners' strong equity positions. As Andy Walton, head of mortgage and housing research for Intercontinental Exchange, explained, the resilience of the housing market is underpinned by strong equity levels, which helps mitigate the risks associated with rising foreclosure rates. Treasury Secretary Bissett claims the housing market will unfreeze in weeks, suggesting mortgage rates are expected to plummet below 6%. Check out Housing Wire's recent analysis that breaks down 9 crucial economic indicators showing why mortgage rates might plummet sooner than expected.